Hi, this is Peter Schiff. It is Friday, December 20th, 2013. Well, this is the week where Ben Bernanke actually announced the Fed's intention to finally begin to taper its $85 billion a month quantitative easing program. The taper is scheduled to begin in January. Of course, Ben Bernanke will not be there himself to do the honors. He's leaving that task to Janet Yellen to try to accomplish. But he announced the Fed's intention, and the markets loved it. The Dow was up 300 points, and in fact, it was up Thursday and Friday. It closed at a new record high. You know, everybody was worried that a taper would be terrible for the market. So when the Fed announced the taper and the market didn't collapse, everybody cheered, and we had a big rally. In fact, there's all this celebration and kind of like premature high fives as if Ben Bernanke has actually accomplished something. Right? He began quantitative easing, and now he's ended it. He is leaving his second term as Fed chairman, fulfilling his promise. He is pulling off his exit strategy. He hasn't done anything. All he's done is announce an intention to taper, and it's only 10 billion. 10 billion out of 85. And remember, the Fed is actually doing 95 billion a month in QE, not 85, because they have to reinvest, or they don't have to, but they're doing it. They're reinvesting all the interest that they earn on a $4 trillion balance sheet, which is now the size of the balance sheet, and it's going to grow dramatically during 2014. Even if the Fed keeps up its taper program, it's still buying a lot of treasuries and mortgages, but it's reinvesting the interest it earns as well as rolling over any principal that matures. So that's why it's been doing about 95 billion a month. So pairing it back to 85 billion, that in and of itself is nothing. In fact, if you remember, when everybody was so confident the Fed was going to taper in September, most of the estimates were for a $20 billion taper. We only got half of that. This is taper light at best, but it's not even that, because the Fed was so worried about the effect that it would have on the market simply by announcing a decision to taper in the future, that the Fed decided to sugarcoat that bad tasting medicine. How did it do that? The Fed changed its language with respect to its commitment to keep interest rates at zero. They've been at zero for years, and the Fed has said that, well, as long as unemployment is above 6.5%, interest rates will stay at zero. Well, now the Fed has changed that language. It's rewritten it. It now reads that the Fed is going to leave interest rates at zero well past the point in time where the unemployment rate goes below 6.5%. So they haven't just moved the goalpost, they destroyed the goalpost. It doesn't exist anymore. It is now open-ended. You can argue, and I would argue, that monetary policy based on this new commitment is actually easier today than it was on Tuesday before they had announced their intention to taper. That might be why the market is celebrating, because they're getting more cheap money, not less. But to say that this constitutes some kind of victory for Ben Bernanke, that he's accomplished the equivalent of, a Hail Mary, or maybe he's just, quarterbacked his team to a come from behind, last minute touchdown, we're celebrating. This hasn't happened. Or maybe he hasn't actually scored the touchdown. Maybe he's got first and goal on the one, and the go-ahead touchdown is in grasp, and he's decided to come out of the game and just let Janet Yellen come off the bench just to move the team that one last yard to victory, and he's, taking credit. That's not what's happened here. Maybe to stay with a football analogy and to draw a better example of the situation that we actually have, right? Ben Bernanke didn't just march down the field. We're not on the 1 yard line about to score the go-ahead touchdown. Maybe it's like the fourth quarter, and Ben Bernanke's team is down by 32 points. All right, so all he needs is to score 4 consecutive touchdowns, get 4 two-point conversions, successfully recover 3 onside kicks. Do that with all without any timeouts. All the timeouts are gone. And then if they can pull that off in regulation, they would have tied the game. So they still need to win the coin toss and get a game-winning field goal. That's what has to be done. And Ben Bernanke, maybe he just completed a 5-yard pass from his own 10-yard line. So it's 2nd and 5 on his own 15, right? And now he decides to leave the game and celebrate the victory and basically say, here you go, Janet Yellen, just mop it up for me. We're almost there. That's the real situation that we're in. This is an impossible thing that Ben Bernanke is pretending that he can pull off, yet everybody assumes that it's a cakewalk, right? I mean, think about this. If Ben Bernanke had to promise to keep interest rates at 0 even longer than he had already promised, to me that shows that Ben Bernanke realizes just how addicted, how dependent the economy is on those 0% interest rates. And here's the bigger problem for the Fed and, of course, for the economy. The longer interest rates are at 0, the more dependent we become on them staying 0. You see, we've got so much debt that 0 is the highest rate we can afford to pay. That's how broke we are. But the longer the Fed keeps rates at 0, the more additional money we borrow. So the bigger that debt pile grows for everybody, for government, for individuals, for corporations. So the more debt we have, the more we need interest rates to stay at 0. Because if the Fed is afraid to raise rates now, how is it going to raise them in the future when we have even more debt? When the debt to GDP is even greater? Think about this. This is supposedly the 5th year of recovery. And Ben Bernanke is talking about the economic recovery. Well, if we really are in a recovery, why do we need QE at all? Why don't we just get rid of it? If we really are in a recovery, why are interest rates still at 0? Why does the economy need interest rates to stay at 0 if there's a recovery? After all, if you look at the current monetary supports that the Fed is providing to the U.S. economy, it is providing more support today during a recovery than at the depth of any recession this economy has ever experienced. So how can we be recovering if we need life support? It's like your doctor tells you you're in perfect health, except you got to stay hooked up to this ventilator, and we can't take any of these tubes out of your body that are keeping you alive. So you got to stay in this bed, and all you got to eat through a tube, and you're going to breathe through this system, but you're in perfect health. Well, obviously you're not. The economy is not in perfect health or in any health if it needs all this artificial supports to sustain it. Following the news, right, that the Fed was going to taper after all. And again, I was surprised by the decision to taper. I think the Fed is underestimating the effect that this taper is going to have on the long end of the market. They're going to keep the short end in check. But now that the Fed has got the taper ball rolling, right, this is going to put a lot of pressure on the 30-year bond, the 10-year Treasury. There is no reason for anybody to own a long-term U.S. Treasury right now. Because if the Fed is actually going to reduce its purchases, then the price of those bonds are going to fall. And so why would you own it for a tiny dividend yield when you can put your money in the stock market or just about anything else that's going up? Why would you buy bonds? There's no reason. The only buyer left is going to be the Federal Reserve, which means it's going to have to buy a lot more bonds to prevent the price from collapsing and rates from surging. That is why I think the fact that they announced the taper, and they may in fact start it, and they probably will start it in January, the fact that they're doing that, they're going to have to unwind it even quicker. In fact, the Fed did not, or Ben Bernanke did not commit to any ongoing additional tapers. It's all data dependent. During his press conference that followed, and by the way, this is the last press conference that he's going to give as Fed chairman, he did lay out a plan in response to a question where he said, well, every time the Fed meets, we will try to do a similar move. So we tapered to 75 billion, then we'll do to 65 billion, then 55 billion, then 45 billion. And so by the end of 2014, they will have tapered all the way back to zero. But what that means is that the balance sheet will continue to grow throughout the year, right? Just at a slower pace, and then eventually it'll stop growing. But none of that is a promise. It's all based on the data. And I could basically guarantee you this, whatever that data is, it's not going to support all of those tapers that Ben Bernanke outlined. I don't think there's any way Janet Yellen is going to follow through with that game plan. She is going to come up with an excuse not only not to taper, but to restore QE not only to the 85 billion that they tapered from, but to something much larger than that. Because the Fed cannot allow the long end of the bond market to collapse because it's going to take the housing market, the economy, and the stock market with it. You know, people are already having a difficult time buying homes with the higher prices and the higher 30-year fixed rates. More people now are being suckered into the adjustable rate mortgages. But of course, the more home buyers who take out adjustable rate mortgages so that they can afford overpriced homes, the more the Fed has to keep those rates low. Because once the Fed allows short rates to rise, then those adjustable mortgages will reset beyond the ability of the borrower to service the loan. And then we already know what happens because we've already seen that movie. But you know, I think the craziest thing at the press conference was Ben Bernanke's excuses as for why the U.S. economy wasn't doing better than it was. And he had all sorts of excuses. Of course, he never actually accepts blame himself. He doesn't even contemplate that it might be his own monetary policy that is getting in the way of a legitimate recovery. But one of the things that he actually said was that the problem was that fiscal policy was too restrictive, too tight. You know, he was doing his part, but that fiscal policy was too tight. It wasn't stimulative. What is he talking about? We have got the biggest budget deficits in our nation's history. We have had year after year of trillion-dollar deficits. Yes, the current year is maybe only 600 or 700 billion, but every prior year of the Obama term has been north of $1 trillion. In fact, when President Obama leaves office, the national debt will have more than doubled during his 2 terms. That means that more debt will have been added to the U.S. economy during Obama's presidency than was added during all the presidents that went before him. That's from George Washington to George W. Bush. Obama, by his lonesome, added more debt than everybody else. And Ben Bernanke says it wasn't enough. When he says that monetary policy was too restrictive, he says that the budget deficits weren't big enough. That if only we had even more government spending, even bigger deficits, that the economy would have been stronger? Not a chance. We could barely afford the deficits that we have, let alone even bigger ones. We have never had more stimulus, both monetary and fiscal, than we have right now. This is record-breaking Keynesian stimulus, and it's barely working. Yes, it's inflating a stock market bubble, it's inflating a real estate bubble, but it's not creating genuine economic growth, and it never will. It is not raising living standards for the vast majority of Americans, and it isn't creating productive, high-paying jobs, and it never will, and Ben Bernanke doesn't understand that. Now, also want to comment, we got the GDP numbers came out today, final revisions from the third quarter, 4.1% was the headline number. You know, that's a 50% increase from the original estimates that the government made. I mean, I don't know if I've ever seen such a big disparity between the original and the final revision. So they were way off the mark somewhere. But if you look at this number, again, you always got to look beneath the surface. The lion's share of the 4.1%, better than half of it, is because businesses stockpiled inventory. Why do they do that? Well, they're anticipating a stronger recovery than they're going to get. And they think they're going to sell a lot of this merchandise. They're not without marking down the price. But I think you're going to see this big build in inventory in Q3. That means that Q4 and Q1 of 14 are going to be a lot lower because the inventories are going to be liquidated. And so you're going to see a big decline in GDP. I think that the third quarter of 2013 is likely the high water mark. It's all downhill from here. And of course, where are consumers getting the money anyway? To buy all this stuff, they're borrowing it, right? Or they're because they have a more expensive house, or their stock portfolio has gone up, or they're just maxing out their credit cards. Now, if you look at the reason for the big upward revision, the government says that consumer spending jumped by, I think, 2%, as opposed to the 1.4% that they had previously reported. But why did consumers spend more money? Two big reasons. They spent more money on gasoline, and they spent more money on health care. I mean, is that a good thing? Gas was more expensive. We had a big increase in gas prices in the third quarter. Oil got up to about $110 a barrel in September. It's come down since then, although now it's back on the upswing. It's about 99 now, but we had a big run up in the third quarter. Is that good news that consumers had to spend more money for gas? Where'd they get the money? They probably borrowed it. And healthcare, is that good news? Well, either healthcare costs went up, which is not good, or we're just sicker and we had to spend more money on medical care, which isn't good either. But either way, it's not really a strong number. And again, the money is being borrowed. And the source of it is the Fed. The Fed knows that this entire phony recovery is built on the foundation of cheap money, 0% interest rates, and quantitative easing. The Fed can't take it away. The Fed can't admit that. This $10 billion taper Lite is nothing but window dressing. It's more of the Fed's bluff, trying to pretend they can do something that they have no intention or no ability to actually do. And of course, Ben Bernanke's not even going to be there. So yes, he can pretend that he started QE and that he ended it, or he began to end it, and simply hand the baton to Janet Yellen. And when she drops it, just blame it on her. Hey, everything was fine when I left. I don't know why you screwed this thing up. We had it, right? I completed that 5-yard pass. I don't know why you couldn't get those 4 touchdowns, but you blew it. I gave you it, and you just, lost it. That's basically the situation. Of course, gold, right? When the Fed announced this tapering, gold sold off. Gold went back down below 1,200 again, I think for the first time, or the second time rather, in about 3 years. Why did gold sell off? Because everything is great. Because the Fed has done the impossible. It's tapered and it hasn't hurt anything, right? This is what everybody believes, right? That the Fed has accomplished its goal. It hasn't done anything. It's talked about doing a tiny bit, but again, as far as I'm concerned, monetary policy is even easier now than it was before they announced this trivial taper Lite. And the rest of the taper is probably never going to happen because the Fed is going to have to buy more bonds, not fewer bonds, to keep this whole house of cards from imploding. Now, is gold going to continue to fall? I don't know. My gut is that it's probably still finding a bottom around 1,200. There is plenty of legitimate support for gold all around the world. Yes, all the speculators who are convinced that everything is great, right? The same people that thought it was great in 2007 or it was great in 1999, that crowd, right, completely clueless about actual economics, is convinced that there's no reason to own gold. And so they're going to sell it, they're going to short it. But there is a larger community around the world, particularly I think a lot of the emerging markets, central banks, China in particular, that see it differently and are using this opportunity to buy as much gold as they can so that when the speculators and the investors figure out how wrong they've got it, right, and they realize that they need to be buying gold, not selling it, there won't be any gold left for them to buy because they would have already sold it, and the people who bought it from them aren't going to sell it back. The gold that China bought, they're never going to sell it. I don't care how high the price of gold goes. They want that gold as reserves for their currency because they know the dollars that they have in reserve are eventually going to be monopoly money. It's going to be confetti. So they need something real to back up their own currency, and they want gold. And so I think that we need to be taking advantage of this opportunity, and don't be worried about all the negativity that's out there and all the professionals who are writing gold's obituary. They've written it before, they'll write it again, but I still think that the bull market has a long way to go. Ultimately, we are headed for a currency crisis. Interestingly enough, the dollar didn't even really rally. It rallied tiny on this news of a taper. Why didn't it rally more? I think that's a very ominous sign that the dollar couldn't really gain much traction against European currencies, for example, against the euro, despite the fact that theoretically the Fed is tapering and we got that big 4% GDP number today. Dollar was actually slightly lower as a result of that. So to me, the dollar looks quite weak, and that's a sign of a diminishing appetite for dollars around the world, a diminishing appetite for treasuries. In fact, we don't have to figure this out. China has told us they don't want to buy anymore. They announced that as a result of the third plenum, that they no longer want to expand their balance sheet, that they want to allow their currency to rise, and they're going to do that. I'm convinced they're going to do that, which is why the Fed is going to have to buy more bonds, because they're going to have to pick up the slack. They're going to have to buy the bonds that China is no longer buying, or they might even be selling. They're going to have to buy the bonds that everybody is selling, because the Fed has basically waved the flag. Sell your bonds. They rang the bell, right? We're starting the process of tapering. We're going to buy fewer bonds in the future than we bought today. Eventually, we're not going to buy any bonds at all, and then we're going to start selling. What is that telling everybody who owns bonds right now? Get out. Get out while you can. Get out before the Fed, not after the Fed, right? So this is going to set that thing in motion. That's why I said that Ben Bernanke, I think, underestimated the reaction. But you know what? I guess he doesn't care because it's not his problem. It's Janet Yellen's problem now. She's going to have to deal with it. Of course, it's not just his mess. She helped make it. She was around. It's not like she's just coming in from outside. She's been at the Fed. She's been vice chair, so her fingerprints are all over this disaster. But she is going to quickly come up with a reason not to do any of this. Again, not to follow through. They're going to have to keep interest rates low. We're going to get more monetary stimulus, not less. That is negative for the dollar. It is going to bring on a currency crisis. That's the only thing that's going to put an end to this madness. And again, a currency crisis is not what the market is expecting. And that is a perfect environment for gold. In fact, with the monetary conditions being easier than ever, right? And if you remember, gold's rally, when gold rallied from under 300 up to, wherever it went up to before QE1 started, 1,200, 1,500, there was no QE. There was just cheap money. Well, money is cheaper than ever, and it's going to stay cheap. Even the Fed is saying it's going to stay cheap with no end in sight, because the Fed can't raise rates without the economy collapsing, so it will never raise rates until the economy does collapse. And what's going to collapse it? Not the Fed. It's going to be the dollar that forces the Fed's hands. It's going to be a loss of confidence when the world wakes up to this con and appreciates and understands the phony nature of this recovery, and then the Fed will no longer be able to keep up this pretense, maintain the bluff, and then it's all going to come collapsing down. And if we thought it was bad in 2008, this is going to be much worse. The sad thing is, the longer it takes, the worse it's going to be. The longer that we succeed in postponing this crash, the worse it's going to be, because we're going to have that much more debt to deal with. We're going to make the problems that much bigger. And if the crisis is already going to be bigger than 2008, if the Fed did the right thing right now, and we had a crisis larger than the financial crisis of 2008, if it happened now, just imagine how much worse it's going to be if it happens in 2014 instead, or 2015, or later. Well, I guess that's it for now. This is probably the last blog that I'll do before the Christmas holiday and the New Year. So again, have a Merry Christmas, everybody, and a Happy New Year. And don't forget to continue to listen to my daily radio shows, the Peter Schiff Show. If you're not listening to it now, make it a habit in 2014. We do it at schiffradio.com 5 days a week, Monday through Friday, 10 a.m. to noon Eastern Time. Bye for now.